So are we living in a fantasy economy, that is? It's time for the bull-bear debate. Our bull today is David Sowerby. He's chief market analyst and portfolio manager at Loomis Sayles.
Hi, Bill.
How are you, David?
Great.
He says the economy is moving right along and the stock market is in good shape. What's that? All right, and our bear will be along in just a moment. David, make your bullish case. And I'm curious.
The bear has no courage here.
Well,
huh?
This is news to me. I'm just now finding out that he's not ready here. But, you know, with record high oil prices, here we are at $67.40 per barrel. And it's starting, you're hearing from a Walmart saying that high gasoline prices starting to cut into discretionary income of their customers. Why would you still be bullish here?
First to the economy, Bill. This is the normal mid-cycle slowdown, the same thing that we went through in the mid-1980s, the mid-1990s in response to a flatter yield curve, higher short-term interest rates, slower growth in inflation-adjusted money, and the outcome is the economy slows down, doesn't come anywhere close to a recession. The Fed does their job, and they begin to ease somewhere down the road, and that ultimately proves for reacceleration in the economy. Stocks respond to that as they have year-to-date. They've been flat, roughly on a year-to-date basis. Then in anticipation that the Fed is closer to being done with the hike in interest rates, the stock market can see a recovery, and it's a better place to be than the Treasury market.
All right, well, so let's be clear now. We're calling you a bull, but you're merely looking for a flat stock market realistically here.
Well, I think between now and year-end, we're going to see a better stock market, that we've got the potential for 4 to 8% gains in the equity market between now and year-end.
What will be the spark?
I think the spark will be that yields on stocks on an earnings yield basis look attractive to bonds. That sentiment has gotten a little more bearish in the last month, and from a contrarian aspect, that's a time for me as an institutional investor to be putting money to work. And finally, most important, corporate free cash flow margin, free cash flow yields are still at levels I've seen that are enviable, better than we've seen since the mid-1960s. That's usually a good backdrop to be a net buyer of stocks.
All right, our bull has arrived.
Good.
He's ready to go. Peter Schiff with Euro Pacific Capital. Peter, you can hear me now.
Yes, I can.
We're pleased to have you with us today. You're using the word recession now, aren't you?
I am.
Why?
Well, I think we're headed for one. I mean, first of all, I didn't catch everything that was just said, but I believe that the stock market has been in an ongoing bear market since 2000. We've been in a correction for the last couple of years. I don't believe we've seen the lows of this bear market. I think we're going a lot lower in the years ahead.
Why?
Well, I mean, first of all, I got to keep adjusting this earpiece.
No problem. As long as you keep your finger to your ear, then we don't care. As long as we can hear you. Go ahead.
Yeah. Well, first of all, I think corporate earnings are going to come under some intense pressures because interest rates are going to keep rising. A lot of corporations have a lot of short-term debt, and people are going to be surprised at just how high interest rates actually do rise. Also, revenues are going to fall because a lot of customers of companies are going to spend so much of their money making interest payments, they're going to have very little money left over to buy products. So you're going to see earnings falling as expenses are rising, revenues are falling. So profits are going to come under pressure. And then with interest rates rising, you're going to have to discount those profits by a much, much higher interest rate.
But let's be clear here. Rates have been rising for over a year. The Fed's been doing that since June of last year. Oil prices have been going up for 2 years now. Commodity prices have been going up for 2 or 3 years. And we're still sitting here today with a pretty decent economy. So what's going to be the tipping point for the economy that you're looking at?
Well, I disagree that we have a decent economy. What we've been doing over the last year is accumulating massive amounts of debt by borrowing from abroad to consume. You know, we haven't been making productive use of this money. We haven't been investing it in plants and equipment. We've been borrowing to go on a consumption binge.
Yeah, what about that, David? I mean, if anything, all that cash that you were talking about that corporate America is generating, they aren't exactly putting it to good use now, are they?
I think, Bill, corporate America is much more disciplined, and that's because they've heard time and time again from portfolio managers that we want to see that you're generating a positive return on invested capital when you invest in CapEx spending for your company, that you don't do dumb acquisitions with too much stock and buy too big of companies, that you institute share repurchase, that you increase the dividends, which have been growing at a double-digit clip for the last year and a half. I have greater faith in corporate America, and as a result of that, and the likely pickup, as we've seen in capital spending, and the better jobs market, that this economy doesn't come anywhere near a recession for the next 2 to 3 years.
All right, we're going to ask you both to stick around. We'll take a break here, come back with our bull, David, our bear, Peter, in just a moment. In fact, we'll find out where they would be investing their money here coming up in just a moment.
First, there are only about 25 minutes to go before the closing bell. Stocks are still in the red, struggling with those high oil prices. You see the Dow Jones Industrial Average down by 70 points, NASDAQ down by about 5.5 points.
And then later, expanding horizons in Asia. We have a fund manager looking beyond China toward Japan and Korea. This is CNBC, America's business news leader.
The stock markets are still in negative territory, although they are off their worst levels of the day. The Dow Jones Industrial Average down by 64 points, NASDAQ off by about 4.5 points, and we've got just 22 minutes to go before the closing bell.
All right, let's continue our debate with a bull and a bear. Our bull today is David Sowerby of Loomis Sayles there on the left, and Peter Schiff is our bear. He's the president of Euro Pacific Capital. Welcome back, both the guys. Before I ask you where you would invest your money these days based on your own individual perspectives, let's talk about another factor in this economy that has helped the economy through these years. That would be the housing market. Just today, very strong new home sales figures for July. Peter, what about housing? That has been the straw that's been stirring the economic drink the last few years.
Well, I agree that our bubble economy rests on the foundation of the housing market, and it's a very weak foundation. The housing market today is very similar to the internet market of the late 1990s. You have a speculative mania. You have mortgage lenders that have basically thrown all lending standards out the window, and anybody with a heartbeat can borrow $1 million with nothing down based on a stated mortgage and use a negative amortization interest-only mortgage to buy a condo at 3 or 4 times what that condo might have been selling for 4 or 5 years ago.
How much longer can it last?
And look, it's not going to last much longer. At some point, the lenders are going to balk. Interest rates are going to keep on rising as more and more housing supply comes on the market. Eventually, the bubble's going to break. I mean, people are confusing house price appreciation with legitimate wealth creation. The only thing that Americans are accumulating is liabilities, mortgages, and those mortgages are going to remain long after the housing bubble bursts. And in fact, many of those mortgages are going to be very, very expensive to service, and a good number of them are going to go into foreclosure.
David, what about that? History would suggest certainly this has been a strong part of the economy, no question about that. It's helped a lot of people make a lot of money, but history would suggest that it is in mania levels here, wouldn't it?
Maybe in the 7th inning of a baseball game, Bill. I wouldn't say it's anywhere near the internet bubble of 1999 and 2000. If you look at the strength of the home builders, even today, Pulte Homes, which is in my backyard here in Michigan, still selling at attractive valuations, less than 10 times forward earnings, that interest rates, unlike the late 80s when California went through that period of 40% price depreciation in their homes, interest rates are much more tolerable today. The economy, I believe, is not near recession as it was back then. And while housing is a little grayer than it was 2 or 3 years ago, there's still a positive affordability factor that helps the home building stocks and those stocks that are related to it, be it a Black & Decker, a Masco, a Leggett & Platt, or a Fortune Brands.
But the problem is interest rates aren't going to stay low. In fact, with a nation with no savings, we literally have no domestic savings, interest rates are going to move dramatically higher than they were.
How much higher, Peter?
We just don't measure savings right in this country when we take income less consumption equals savings, and they're not counting things like my home is my
But your home is not savings. That's not a form of savings. Home equity is not savings.
It's an asset to me, and I sure believe that's a form of savings.
But it's not savings. It can't be loaned out to an entrepreneur. It's not money taken out of consumption. That's nonsense. It's not savings. And home prices can fall just as easily as they rise. In fact, they can fall a lot quicker, and they will. And if you're counting your home equity as savings, people are going to be in trouble who are doing that.
How much higher interest rates?
It is part of my net worth, and I
but
think
it's not part of savings.
Interest rates are headed higher, but not much more higher that it would throw a wrench into this economy that still has favorable growth rates for the next couple of years.
Quickly, how much higher will rates go, Peter?
Well, I don't know. I think they're going to go very high.
Be much higher.
I think they're going to go double digit. I mean, I don't know if the first digit is going to be a 1 or something higher than that. But rates are going very high in the United States. That's a problem. We have no savings. The reason that rates are low right now is because foreign central banks and speculators are buying U.S. Treasuries, but the rate of inflation is far in excess of the yield on the 10-year. And there's no real private demand around the world for U.S. dollar-denominated debt. There's certainly no domestic demand for it. Rates are going a lot higher. I mean, the
10 years yielding about 4.2% or so today. The underlying inflation rate is about 2 or 2.5%.
Well, that's what the government says. That's not what the real inflation rate is. I mean, if you don't want to believe these government numbers, but even the actual
but I believe
government...
in the personal consumption expenditure deflator, which is still suggesting inflation is at a relatively low level, and I worry about inflation more than most investors do.
I don't know what those numbers are suggesting. I know what reality is, and I know the investment advice that I've given out for the last 6 or 7 years has been predicated on the fact that there'd be inflation. But what we did to protect ourselves is we didn't want to believe these government numbers. So what we did is we bought non-U.S. dollar denominated foreign stocks, and we can see the result of what we've done because the inflation has caused the dollar to decline by about 1/3 over the last 3 or 4 years.
I know it's not fair, but in the time remaining, I need one investment idea from each of you. David, you first.
I think the consumer will continue to do well. We saw it today with Coach, DirecTV, the travel and leisure stocks like a Carnival Cruise or a lodging, Marriott, Starwood. There's great opportunity in consumer discretionary as there is also in the technology sector, Bill, and particularly semiconductors.
Peter?
I disagree. The consumer is in great trouble. So is the entire U.S. economy, which is predicated on consumers' access to cheap foreign
for 20 years on the consumer, and it's always surprised us on the upside.
Well, in any event, I would advise people to continue to move their money out of U.S. financial assets entirely, out of U.S. bonds, out of U.S. stocks, certainly out of U.S. residential real estate, and out of the dollar. And what they can do is they can do what my clients have done so successfully over the years, is buy assets, conservative dividend-paying foreign stocks around the world to get real inflation protection and get an income stream denominated in a foreign currency. So as the U.S. dollar declines in value, you get an income stream that rises to compensate for that loss of purchasing power. I
trust you two won't be having lunch anytime soon, but we thank you for joining us
today. This was a great discussion. Thank you, Bill.
David Sowerby, Peter Schiff, thank you for joining us today.
Thank you.